In today's conversation, we dive into real estate investing. My guest is Dave Meyer, the Chief Investment Officer of BiggerPockets, the investing community with over 3.5 million members. Dave leads that community with analyzing housing data, economic trends, investing tactics to help investors make informed decisions. He's been an active investor for more than 15 years. He's the host of several of BiggerPockets podcasts, which have hundreds of millions of listens. I invited Dave in to talk about investing in today's market, how it's different from last decade, how the math is changing on the residential investing business. We also talk about how the best agents work with investors and what investors are looking for. We cover so much ground. I learned a ton. So stick around for real estate conversations with BiggerPockets' Dave Meyer and me, Mike Simonsen. Dave Meyer, welcome to the show.
Mike, thanks for having me.
Let's start first with BiggerPockets. Tell me about the community and the mission and your role there, so that we set the stage about who you are and the work that you do.
BiggerPockets is the largest community of what we call retail real estate investors in the world. So just normal people with W-2 jobs, some people doing it full time, but people who are primarily buying rental properties, buying fix and flips properties, and using it to either supplement their income, or most people are trying to actually retire early using real estate. Company is sneaky big. We've been around for over 20 years. We now have 3.5 million members that we are helping pursue financial freedom through real estate. And my job there is the Chief Investment Officer. And, a lot of people think BiggerPockets is a real estate company. We're actually mostly a media company and a software company. We build tools that help people do this. So my job is to sort of be the resident expert on real estate investing. I've been investing myself for 16 years. I'm also a housing market analyst. And so my job is to try and help people understand what strategies are working, what tactics are working, how to invest in different market conditions in different regions of the country, which is a very fun job and allows me to come and talk to people like you, Mike.
That's great. And we're going to talk about all of those things about investing and the trends and how to do it today, because I think it's changing today. But also, it is a sneaky big company. It's funny, when I go on your podcast, I've had friends or acquaintances say, "Oh, I heard you on the Dave Meyer on the BiggerPockets podcast." Like they people who are, as you'd say, retail investors. They have one or two properties. They're maybe house hackers. They're fans. They're hobbyists in the space. They like to be in real estate. Yeah.
Yeah, it's sort of a lifestyle brand. Like, people get really into it. I think a lot of people who are real estate investors, it's a big part of their personality. It's a big part of their life. They socialize with other investors. And so BiggerPockets does a lot of things to try and facilitate that. A lot of it's online. We have huge forums, but we have in-person events. We have an event called BPCon, which is one of the most fun. I mean, it is the most fun conference I've ever been to. And I'm not just being biased. They make it really fun. So it's more than just nuts and bolts of investing. It really is a community.
It's a remarkably big community in industry in the U.S. How many people are individual investors or want to be investors, aspirational investors, or are in the space, at least in some way. It's a lot of people. It's really fascinating. And Josh Dworkin, the original founder.
Yes.
Of BiggerPockets, was essentially blogging back then.
Yes.
And it was roughly around the same time that I started Altos Research, like 20 years ago.
I didn't realize that.
So I knew him way back then, and watched him really build a real content business while I was, slogging away building Altos.
Well, you've done quite well with Altos as well, but different businesses.
Different businesses. Okay. Yes. So sure. So, okay. So let's first, so you mentioned the retail investor. Tell me more about the investor, the real estate investor in the U.S. right now. We hear all the hand wringing and the about the institutional investors and the Wall Street investors, and there's all kinds of headlines and policy things being thrown around, and they're being investors in general are vilified. But tell me about the landscape of investors in the U.S. right now. Who invests in real estate?
There's a very common misconception that Wall Street owns all of the rental properties in the United States, and their share of ownership has gone up, but it still remains in the low single digits. And according to some government data, actually 90% of all rental units in the entire country are owned by people who own 10 units or fewer. And this is, for some reason in the industry, they call mom and pop investors. I don't really know why, but that's what the term is. But it's just normal people who buy a couple of rental properties. It's people who, buy a home that is a duplex and rent out the second unit, or acquire 4 or 5 single family homes, pay them off, and use them to fund their retirement. I would say that in the 10 years I've worked at BiggerPockets and the thousands of investors I have encountered, 99% of them are just what I would call normal people, just people who are working full-time jobs, who are nurses or teachers or executives at a business, and who just don't really see the traditional path to retirement or the traditional path to wealth as working anymore. I'm with them. I personally am not buying into Social Security being around for me when I'm ready to retire. I think you see, it's harder and harder to retire. Fewer and fewer people have a pension. 401ks are available to about half of Americans. And so these people are entrepreneurial. They want to take ownership of their financial future, and they're using real estate as the means to do that because, unlike a lot of other entrepreneurial endeavors, real estate's pretty proven. It's not easy, but it's simple. It's a simple business model that has been proven over and over again. You're not disrupting anything. You don't have to invent anything new. It's just a way that if you are willing to learn some basic fundamentals of the industry, that you can really legitimately build long-term wealth. And so that's I'd say the primary makeup of our community.
And that's I think a great insight. It's a fundamental view of our society, of our social structure, that it is a path to security,
Mm-hmm.
to wealth or security, a long-term security.
Yeah, I personally think it is. It's worked for me. I've been doing it for 16 years. And I just think that people think real estate is like the stock market or the crypto market where, you're trying to buy low and sell high and, doing all of this, short-term types of trading. But real estate, if you just give it time, is a fantastic investment. And although I do think the term real estate investor is a little bit of a misnomer because it is entrepreneurship, you are starting a small business. It's more work than crypto. It's more work than buying a stock for sure. It is not fully passive income, although there's a range of how passive you can be. I just think that if you do it the fundamentally sound way and think about it with a long-term perspective and say, this is going to take me 8 years or 10 years or 12 years, you really can change your life through real estate. It's just not a get-rich-quick scheme that I think people on the internet sometimes make it out to be.
Yeah, the allure of passive income is, the thought of, I'm just going to have somebody paying me rent every month and it'll be passive. It's kind of a funny thing. But I like the distinction between the concept of investor and entrepreneur. Do you think about that? Do you talk about that in your language and the work that you do, like at BiggerPockets?
We do. I think it's really an important distinction because when I think about the investments I make, when I invest in the stock market, I either put in an index fund or I occasionally buy individual stocks and then I do nothing. Same thing, I don't own much cryptocurrency. I have a little bit just for fun, but you do nothing with
Yeah.
it. Even
Yeah.
the most passive forms of real estate investing, and we could talk about this, but there are some forms where you really do very little. You still have to do a little bit. It's still a couple hours of work a year. But I do think, for most people, when you're starting, if you're going to buy your first rental property, if you're going to flip a house, it's going to be work in the first couple of years. That's not as hard as a full-time job. It's definitely something you could do in your spare time. That's the majority of people at BiggerPockets are doing this in addition to a full-time job. But it is work. Over time, as you build a portfolio, what I've observed is that most people are able to make it increasingly passive. When I first started, like the first deal I bought, it was a 4 unit. I, was just managing the property myself. It was probably 5 to 10 hours a week. Now I'd say I spend 5 hours a month on my real estate portfolio, which is much larger than just 1 unit, right? And so you build systems like a business person. You figure out who to hire, what resources to use, what software you should use. And over time, it can become relatively passive, but you still got to pay attention. Like I still am, talking to my agent every once in a while. I chat with my property managers. I still have to do the asset management piece and decide which units I want to upgrade and sell and hold on to. So, but I find that to be the fun part personally. I think it's fun to like sort of do the portfolio level strategy. Most people eventually want to get out of the property management side of things, which is luckily pretty easily done either through software or hiring a professional.
Okay. Well, there's a lot of threads there to talk about the building the portfolio over time, the different styles of investing, which are more passive than others. But I'm interested in one other thing about the community, and really the demographics. Like, what do those people look like? Are they? Is it? What can you tell me about the demographics of the real estate investor and or of Bigger Pockets audience?
It's remarkably diverse, which I think is really cool. It's one of the things I love about the BiggerPockets community is when you go to a meetup, you go to BPCon, you'll meet everyone from a 22-year-old hustler who's just trying to figure out how to scrap together money to get the first deal to folks who are in their 50s and sort of just had a realization that they're not on track for retirement and they need to do something a little bit more proactive with their money. And everyone in between. I would say like the average person is probably in their 30s and has a full-time job and goes out and buys a property every 2 to 3 years as they save up money and are able to reinvest the cash flow and the capital that they make from their first deal. So that's the cool thing about real estate investing is, it's capital intensive. Real estate is. First deal can be hard to get, but once you get that, the second one's a little bit easier. The third one's a little bit easier. And we teach these sort of strategies on how to use capital and equity from different deals to fund them. But that's the average person. We do have people in our community who go into it full time. They're flipping 5 houses a year. They're going out and buying big multifamilies. That certainly exists. And those people, not wrongfully, are the more vocal people, I think, on social media. But I think actually the sort of more silent majority is just a husband and wife team who's, got a couple kids and wants to manage 4 units and they buy it in their 30s and they hope that, but they will, if they pay it off by the time in their 60s, that's going to fund their retirement.
Yeah, that's fascinating. I have friends, entrepreneurial friends, who sold a business. They were kind of between businesses for 18 months or so, and they flipped a house in that time. And
How'd it go?
yeah, and did the work, and they put it. They did a lot of the work themselves, and it was. I don't know. It was, Northern California, so it takes a little bit of cash. It's not
Yeah.
like doing it in Indianapolis or someplace, but took a little bit of cash, but I think it, gave them some income for the year and it gave them a big project. And then she went off and bought another company and is now running that. It was
Oh,
like that was
cool.
their year's project.
Nice. It can be fun. Like it takes it. I'm not a big flipper. I've done a couple of them, but that is the opposite of passive income right there.
Yeah.
It's definitely a lot of work.
Well, that's great. Let's talk about the strategies then. So flipping is one, but obviously you mentioned multifamily, like big multifamily stuff. But talk to me about what are the big strategies that people do, that investors do?
Yeah, I think of it as a spectrum. There's basically, on one end, there's relatively low risk, lower reward. I don't think anything in real estate is low reward. It's not like buying a bond. You're still going to get double digit ROI on even a quote unquote low end of the spectrum. And then there's, really higher risk, high intensity, but exceptionally high opportunity for returns. So on the lower end, I would say it's just regular rental property investing. Going out and buying a single family home or a small multifamily that's anything up to 4 units and renting them out. It's about as predictable as business gets. There's still things that come up. You're still going to have a broken water heater. Things come up. But, your returns in that are pretty predictable. For me, what I advise people is you got to look for something that's going to get you a 12 to 15% annualized return minimum. And that's because, in my opinion, if you're going to be an entrepreneur, it better beat the stock market. Because if I'm only getting 8 or 9%, I might as well stick it in equities and do nothing and then have no worries. But if you get 12 to 15%, might not sound like a big difference, but over the course of 15, 20 years, if you're compounding that, that's a difference of usually millions and millions of dollars by the time you retire. So that's what I usually advise for people. The next sort of step up the ladder in terms of intensity and potential returns and risk is sort of like the hospitality types of investments. So that's either short-term rentals, like owning an Airbnb, or there's an emerging class that called midterm rentals that's very popular right now, which is like renting furnished units to travel nurses or corporate travel or insurance dislocations. So that's really profitable. You can earn higher returns, 15, 20, 25% on them. It's more work though. So that, again, that's sort of like moving up the spectrum. Next, I would say is you sort of get to large multifamily, which is out of the sort of normal retail investor, but some people graduate, so to speak, from smaller units and want to go out and buy the 20 unit or the 50 unit or 100 unit. That is not that different of a business from buying a 4 unit, but the debt structures and the financing and the management is more complicated. So it does carry more risk there. It's also much more susceptible to macroeconomic cycles than residential real estate. Residential, I know everyone listening to this, a lot of us who were around in 2008 are still wary of the residential crash, but that's pretty unusual. Whereas commercial real estate does have more regular economic cycles. So there is market timing there. And then sort of on the high end, I think there are two different things. One is development. So building stuff from scratch. Great way to make money if you know what you're doing. Highly dependent on macroeconomic conditions. You're buying something. It takes 2 or 3 years to develop. You have no idea what could change in the world in 2 or 3 years. And so you could be selling into a very different environment from the one you bought in. So that can be risky. And then flipping is sort of at the high end there. You could double your money in flipping in 6 months. Like you could get phenomenal returns. There's also times you lose money. And I think it's very rare that you really lose money as a rental property investor, especially if you have a long time horizon. But as a flipper, a lot of things can go wrong. Everything from market timing to buying a house and opening a wall and finding something you were not expecting. So it's high risk, high reward. Even the best flippers in the world still lose money on some deals. It's just, that's the nature of the game. But it's a fantastic way to earn an income if you've got the skill and the temperament for it.
Man, I have so many questions on all of these. That's a terrific
Let's go.
spectrum, and I like it. So let's start though with your comment about a 12 to 15% targeted return on just being a landlord, just buying a house
Yes.
and being a landlord. Do you factor in home price appreciation or into that calculation?
the great debate. Yes, this is a great debate among investors. So I personally do.
Okay.
I consider appreciation, but I personally never like underwrite a deal to have more than 2% annualized appreciation. I think I'm basically counting on inflation. And I am that is sort of an inflation hedge part of my own strategy. Some people don't. I think historically, if you look at appreciation rates, I think it's like 3.4%, something long term. And
Depending on how you
so
measure. Yeah.
I even go under that because I just don't want to count on it because it's so out of my control. The main other three drivers, or really there are four sort of drivers of returns in rental property investing. The first is the obvious one, which is cash flow. That's what people want. It's, you take your rents, you subtract all your expenses, you make some money off of that every year. Sometimes you can earn 2, 3, up to 10% cash on cash return just there. So that's good. The second thing is just paying down your debt by amortization. People call it loan pay down, whatever it is. But you're basically, some of your expenses are actually just paying down the principal on your mortgage. And that actually generates a return as a real estate investor, usually in the 2 to 4% range. And then there's amazing tax benefits, which I factor into my own return as well, because with most real estate, you are going to be able to offset your cash flow income with depreciation. And so if you earn, let's just call it 10 grand a year from rental property investing, that's more like making 13 grand a year in in a W-2 job because you're not paying the same amount of tax on it. So those are the four. And then the fifth is different from I'd like to separate two different categories. One is market appreciation, which is what most people think about, which is just the macroeconomic forces of supply and demand pushing prices up over time, or whatever it is, inflation, yeah, whatever it is, those things. There's this whole other category, which is what we call either value add or some people call forced appreciation, which is just basically improving a property and ideally improving the value of that property by more than it costs you to improve it. This is the whole idea of flipping, right? You buy something at 200, you put 50 into it, you sell it for 350, boom, you make some money. You could do that with rental property investing too. That is not just a flipping strategy. This is my primary way of investing is I'll buy a rental property that needs some work. I'll renovate the units. I'll fix the kitchens. I'll make it a nice place to live. That increases the rents, which increases the value of the property. And I've built equity through that effort as well. So I combine all of those things. And if I can get a 12 to 15% return, I feel like it's pretty good. 15 to 20%, you're definitely doing well.
Yeah, I mean, 12 to 15% if you can reliably get that, that's amazing return on it on anything.
Yeah, it really is.
But it sounds like very well, deeply planned out, and well executed. You got to spend right on your renovations and do
Yes.
those kinds of things. You have to underwrite the deal properly. Let me ask you though, how has that model changed in the last 4 years? And or any of the models changed in the last 4 years? And even looking forward now for the next, say, 4 years, we are, if you are buying in Austin, Texas in 2022, there's a lot of investors still moving
Yep.
in Austin in 2022 and Tampa, and like even
Hurts.
if you were doing it in Denver 18 months ago,
Yeah.
right?
I invest in Denver. Haven't
Yeah.
bought there since
So
2018, so I'm doing okay. But yeah, I
you're
invest
doing
in
okay,
Denver, so I'm well aware. Yeah.
so how has the math changed? How has the strategy
Yeah.
changed in a world where it is no longer obvious, like the last 15 years, that home prices are going to climb?
hmm
What if
Yeah.
home prices are flat for another decade?
I think they might be. I don't know about a decade. They might be, but I agree with you, Mike. Have called this on our show. I call it the Great Stall. You've probably heard it called many different things, but I think home prices are going to remain relatively flat. They're declining in real terms, right? So like I think that is probably still going to happen. And I think you use the word I think is the most important here for real estate investors to consider, or agents working with real estate investors, is that it's not as obvious. The obvious part of it is gone as a real estate investor. In 2021 and 2020, everyone was like, oh my God, real estate's going up 15% a year. I was just going to buy a house, do pretty much nothing, and make a ton of money. That was pretty obvious to do. But I will say that there have been many times in history when home prices were flat, especially in real terms, and in inflation adjusted terms. And real estate investing was still a good business. Like, you don't need appreciation to go crazy to be a real estate investor, but you do need to be a little bit more skilled. You need to sort of change the mix of those buckets that I was just talking about. Rather than counting on appreciation, I told you, I think of that as maybe 2% a year, and I need another 10 to 15% sort of. So I need to figure out where I'm going to get that from. And I think value add and forced appreciation is the best, most reliable way to generate great returns right now. You see this in the market. You're probably aware of this, Mike, but when you get a sort of a declining market or a flat market, the delta between renovated nice homes and homes that need work usually increases. So like stuff that's really great still sells. I'm sure all the agents listening know, days on market for a nicely polished home, way lower than the place that needs a full gut reno, right? Like that's just how it works. And so the delta grows, meaning that investors can actually buy product at a much lower rate. And so even though their sale price eventually, or their after repair value of what it's going to be worth once they fix it up might be flat or a little bit lower, there still is margin in there to do it, but you need to be good at that, right? Like it's not like you could just go and buy something and hope that it's going to go up. The other thing I'll say is that cash flow, unfortunately, is just harder to get right now. And that's the big challenge, I think, for most real estate investors these days, is that in the 2010s, we had a really unique time in history where after the financial crisis, home prices went down 19, 20% nationally. Rents, I think, went down 6 to 8%, depending on who you ask, right? And so that created this really excellent time for real estate investors where you could generate really strong cash flow just going and buying things off the MLS. That is not as possible. In certain markets it is. In the Midwest you can do it. In certain areas of the Southeast you can do it. But in the average market, it's going to be harder to do that. And so you need to employ different strategies, either things like, doing what I'm suggesting and doing a value add that can generate cash flow for you. Being able to buy off-market deals, that's a way to do it. Going into higher cash flow earning strategies like midterm rentals or rooming houses. They call it rent by the room now. Those kinds of things can do it. So it's up to each individual investor to figure out how to generate cash flow. I personally am not a super cash flow oriented investor. I don't care if I get 10% cash on cash return. I focus on that overall return, but I will say I do not and never have and never will buy a property that does not at least break even. I think the key to being a real estate investor is to hold on. The main way you make money in real estate is waiting. And so if you buy something that doesn't cash flow, it could be tempting to sell. If you have a bad year at work or you get laid off or whatever, it could be tempting to sell it if it's costing you money to hold on to those properties. Meanwhile, if you have a cash flowing rental property, that helps mitigate some of your other risks to your income. Even if it's 2-3%, that's fine for me. But I will need to have a lot of appreciation upside. But I think people should think about which parts of the which different ways of generating a return they're good at, are available in their market, because that's another thing. It's totally different whether you're in the Midwest or in California, which of these things are easier to generate. But as long as you're getting to that 12 to 15%, and you still absolutely can do that, even in this market, I think it still makes sense to do it.
Okay. It's cash flow is harder because, when interest rates are at zero, everybody looks like a genius. It's like,
Yep.
Yeah,
exactly. I always call it the Goldilocks era. I think like in the 2010s, right? If you asked ChatGPT to design you the perfect investing conditions for real estate, it was 2013 to 2022, right? You just demographic tailwinds, structural supply shortages, cheap money, all these things were going so well for real estate investors. And that's great. I benefited. I was lucky to get into it during that time. A lot of people benefited, but it's still a good business. It's just not as obvious.
And do you notice shifts in like enthusiasm now? Like, is it weeding out the real like sort of aspirational or the get rich quick people? Is that happening a little bit?
It is. Yeah. I think we see fewer people, I'm sure all the agents listening to this feel, there's a lot of tire kickers in real estate, right? Everyone wants to look at listings and that kind of stuff. We're getting fewer of those, I think. But I don't know a single experienced investor who's like stopped investing. Not a single person who's been in the business for a couple of years. They're changing tactics. They're being more discerning. I think that's really important right now, is to be very careful about what you buy. But serious investors continuing to go. I still see a lot of people getting into it, people who have the right long-term mindset. But anyone who's trying to get into real estate to make money and have it be meaningful in their life in the next 3-4 years, like those people are gone, because you can't do it. It's unless you're flipping, 3-4 houses a year, which you can, but that's a job. Like that's not really investing. That's just working a different job.
Yeah. Right. You're driving around a big white pickup truck at that point.
Yeah,
And,
right.
yeah.
I mean, it's like I know a lot of people who have quit their jobs to flip and then gone back to work because they said work was easier.
For sure. You mentioned finding off-market deals, and I'm interested in finding deals and working with agents and like tell me about that landscape. I know a lot of agents who have real big businesses finding properties for investors, they have an investor business. So tell me about that landscape, working with agents and agents working with investors.
Well, hopefully I'll be endearing myself to your audience here, Mike, because I will say I almost only buy deals on market. I have bought one off market deal in 16 years of being an investor because I work full time. I don't have time to do off market deal finding. There are great ways to find off-market deals. You could do direct-to-seller marketing, postcards, all these different things, or just networking. And you can find great deals that way, but it's time-consuming, and it's actually more expensive than I think real estate investors think. You're sending out mailers. It costs a couple bucks. You have to spend thousands of dollars on these things. So I personally rely on real estate agents to find deals with me. And those are some of the best partnerships that I've had as a real estate investor. I invest in multiple different markets. And so I have agents that I work with across the country. And I will say that they are usually able to find me the kinds of deals that I like. A lot of them do their own off-market deal finding as well. And I think that's, to me, if you're an agent listening to this wanting to work with investors, which I would always recommend. We're good repeat clients. We tend to buy more than homeowners. And I think that's something that I've always liked about some of my agents is either being able to find pocket listings, off-market deals, making introductions for me. And although I've done that, I usually buy the on-market deals. I tend to buy those as well. So I think working with agents for investors is a no-brainer. There's no reason why you should focus entirely on off-market deals. It got really popular during COVID for some reason, but I think one of the benefits we're seeing of increased inventory right now is that the supply of deals on the MLS is just getting better and better. I noticed this myself in the deals that I underwrite that, I'm just seeing more appealing things on the market. As an agent,
That's okay.
though, go ahead.
No, keep going.
I was going to say, I
You-
think, I interview a lot of agents and every time I go to a new market. I also interview a lot of agents on BiggerPockets and the podcasts and stuff. And I'll say that I can notice a difference between agents who have committed themselves to be investor focused, or at least investor friendly agents, and those who are not. And that's not disparaging. Agents should pick your specialty. But I will say, if you want to work with investors as an agent, learn the language of the investors and learn what they care about, because sometimes you can tell, people are showing off features or school districts, and some of those things matter. But most investors really just want to know the numbers. And if I work with an agent who can't help me understand cash on cash return, who doesn't know, I think one of the things I really rely on agents for is something we call ARV, the after repair value, which is if you're going to buy a property for 200 grand, you're going to put 50 grand into it, what's it worth after that? And I need an agent to help me comp out those deals and figure what those things are worth. And so as an agent, these are kind of things that you can think about working with, that you should learn and get good at if you want to work with experienced investors. Learning the different strategies is super helpful too. Sometimes I'll buy a property and I'll talk to an agent. They'll say, this won't work as a long-term rental, but we have great midterm rentals in the area. I know this other investor who's making blah, blah, blah in cash flow. Those kinds of conversations are super helpful. And the last thing I'll say is, some of my agents, I really appreciate about this, have really gone in on investing. They have calculators, or they subscribe to BiggerPockets.com. They can get a calculator and they'll send me deals. They'll be like, I like these 3 for you. And they'll analyze it for me and send it over. And you don't have to do that, but man, it is an effective way to close deals. Those, when you send me a deal where I could see what my return is going to be, I am much more likely to act on that than when I just get sort of a drip campaign from an MLS where I'm seeing 50 deals that came on the market that week. Those kinds of things can really help differentiate you as a real estate, as an investor-friendly agent. And again, I'm not an agent, so I don't want to tell you your business, but I will say I know agents who have 5 to 10 investor clients, and that's their whole business, because they buy 10 properties a year each, or 5 properties a year each, and that can move volume. So it's up to you, but it can be a lucrative part of the market, I think.
That's those are really great insights. I like the simply being able to master the after repair value is a it's a powerful part of the process, but it's also establishing, as an agent establishes, I understand the market, I understand the players, I understand my customer, that. There's really great, and you probably have calculators and things that you can drop in assumptions. You can for an agent to go do that for, and even in places like, I live in the Bay Area in California, where, you might be spending $1.5 million on a house, but it's almost a tear down.
It's great. Yeah. It's the same.
How do you, how do you, you want to communicate the after repair value?
Yeah, absolutely. I just did one of my first flips here in Seattle, Mike, and agent came to me and said, you're going to buy this property. It needs a lot of work for $825,000. And it was a complete gut job. Complete everything needed to be done. Yeah. But they said, you're going to sell it for $1.45 million. And you know what? We just about hit the ARV. So it's it was worth it. If they were wrong by 50 grand, 100 grand, that would have hurt my bottom line. It could have turned me negative. So those kind of things really do matter and really help. I'll say, the other thing is rent comps is another really good number to know what you can rent a particular unit for. So whether that's subscribing to BiggerPockets or Rentometer, or just networking with property managers, talking to your existing clients, that's another great way to build trust with investors. If you have realistic understanding of how much rent and revenue a property can bring in, that's another really powerful thing that investors will appreciate.
Yeah, those are really great insights. I like these deals for you. Do you hear the rent comps? That's really terrific. I like that insight. That's insight I was interested in getting today. So thank you for those.
For sure. And luckily, I'll just say, Mike, those things are kind of easy to get. It's super easy to get. And I think I'll just give you one more, Mike, is I think having a philosophy about your market is the last thing, a great way to work with an investor. If I invest out of state in a lot of different places. So if I go to a new market, first thing I usually say to an agent is, what's the move here? I've done my research and I kind of have an idea of what I want to do. But if you could say if you're just oh, everything's growing, it's a great area, we love it, you can buy, what do you want to see? That's fine. That's, helpful. But if you're hey, There's three markets, there's three neighborhoods I really want to show you. I am seeing really good rent growth in these areas. There's high tenant demand in these areas. Vacancies are low, and the acquisition price is still reasonable. I think this is going to get you the kind of deal you want. Like, I love that agent, right? Like we're a team then. It's not just, me telling them what I want to buy. We're working together to find the great deal. That's kind of the dynamic I think most investors are looking for.
That's great. And when you go to a new market, do you sort of know already, or like, oh, I need to go do Denver, or are you shopping for dynamics in a market? Are you going like, oh, I think I can get this, Indianapolis, whatever. So I'm going to Indianapolis. How do you pick a new market?
Everyone does it differently. I have this sort of long-term thesis about the housing market that is centers mostly around affordability. I just like markets that are relatively affordable. I want places where the average person in that area can afford the average price home. That's not to say you can't invest in Seattle and San Francisco. People make loads of money investing in those markets. But for me, as a long-term buy and hold investor, my objective is stability. I just want things to be normal, low vacancy, low drama. And so a lot of the markets I like right now are in the Midwest, in particular. I still want strong fundamentals in those markets where there's good household formation and there's economic activity in the area. But I like to see affordability. I don't want, both for financial and for just sort of moral reasons, I don't want my tenants stretched every month to pay their rent. I want them to be able to comfortably pay the rent that that we agree upon. And so I really like that. I am a big believer in quality of life as well. I think more people are moving places where they feel less people are moving, I think, for jobs, and a lot of people are moving for quality of life. We'll see if that changes in the next few years. But, I invested a lot in Denver, and a lot of that city's growth sure was economic, but people just want to live in Denver because the weather's good, surprisingly good if you've never been there, and access to the outdoors. It's a fun place to live, right? It's a great place. Austin, similar, the supply side of Austin's a little under controlled. And then that brings me to sort of my last thing is supply. I think this is the thing most investors miss, most homeowners miss, is they think about demand only. They're like, where are people moving? Well, a lot of people moved to Austin, but they built even more apartments than the people who moved there. And so prices are going down, rents are falling, and that's a problem. That's why I like the Midwest. They're affordable. People don't really build in the same quantities in most, Indianapolis, they build a lot. But if you go to a city like Detroit or Chicago or Grand Rapids or Madison or Milwaukee, like they're not building a ton, but there's still good economic situations there. And they're relatively affordable. So I really like that. And then honestly, I always joke about this on the podcast, but I invest for vibes. Like, I don't know how else to say it, but like I've gone to some markets and I'm just like, nah, I don't like it here. I don't want to be here. I don't want to like come back here and visit these properties. It's just, I also just don't get it. Like, I went to San Antonio. I liked San Antonio. It's like sprawling. It is so big. It's all single family homes. I like couldn't figure it out. I was like, where do people want to live? I don't understand it. Whereas if I go to Denver, where I've done a lot of my investing, like you can tell there's a downtown and then there's concentric circles of like value outside of that. I like being there. There's good energy there. I want to, if I've got to go visit my properties, I'm going next week. I'm pretty happy about it. I like to go hang out there.
Right.
For me as an investor, it needs to be sustainable. I don't want to just pick places for the math of it. And it needs to be convenient. So, I have some other rules about picking markets, but I don't need to get into the weeds there.
Well, those are terrific insights. The one I want to dive into a little deeper is the concept of this quality of life, good vibes, but also affordable.
Yeah.
Right? Like,
it's hard.
Yeah, it's like, so, I have friends and relatives in Detroit, but Detroit's an easy example of it doesn't have great household formation, right? It's negative population, but that's why it's affordable. How do you balance that? What's an example of an affordable market that you also go like, oh, it's gorgeous here. I love being here.
Yeah.
Kind of, what's a good example of that?
I'll give you an example of a place I've been investing in, Grand Rapids, Michigan. I'm a big fan of
Okay.
Grand Rapids. It has not crazy population growth. Probably know this, but the whole state of Michigan, it's kind of losing population. But a lot of
Yeah.
in-state migration is going to Grand Rapids because it's a
Okay.
fun place to live. It's
Yep.
really beautiful old downtown. It's historic. They're investing a ton. They're getting they're just built this huge amphitheater downtown. They're building a professional soccer stadium. There's there's two universities. There's a massive medical hub. And so there's just a lot of good stuff going on there. People want to live there. There's a well-diversified economy. But the average single-family home's 240 to, as a real estate investor, if you're buying something to fix up, it's in the ones, so like there's still availability there, and places to grow like that. So I think that's a good example. Indianapolis is a good example. I think it's probably reaching the less affordable part
Is
of
it
its
really?
life cycle. It's for the average person there, but it is.
Okay.
But I still think for investors, it makes a lot of sense. That kind of market, tons of economic activity there. The government is investing into, the state government is investing into the area. That's another thing I love to see. I like Madison, Wisconsin. I think that's a great market. Columbus, Ohio is a great market. Actually, you see places in Western New York, like Syracuse, New York, Buffalo, like these kinds of places. I went to school in Western New York, so I'm not just dumping on the area. I wouldn't say high quality of life in Buffalo. For me, it's too cold. That's just not my jam. But it's not just the Midwest. I actually think places in Tennessee, you see this in Georgia, you see a lot of areas. Winston-Salem, Georgia, or Chattanooga, Tennessee. Like these are places that people want to live. They're cool spots. They're fun. Young people are moving there, which is, I think, really important because one, it supplements rental demand because a lot of young people rent. But as they get into their late 20s or early 30s, they're probably going to want to buy, and that's going to help, at least put some upward pressure on appreciation, even if we're in this flat era. So those are the kinds of things personally I think make a lot of sense. I do believe you can invest in any kind of market, but as an out-of-state investor, I think those are kind of the big things that I would recommend looking for.
Got it. Okay. Those are great insights. I love those. I love the specifics too. So thank you.
Yeah, of
The,
course.
I'm interested in thinking about the contrarian analysis. So I've watched over the years the most sophisticated, super high tech, data driven investors, a lot of the Wall Street ones, a lot of the tech company type investor related companies, all data driven. And then I watched them do, we had the whole model, the
iBuyers.
open door model,
Yeah.
those kind of things where, I watched them essentially be entire 100% pro-cyclical. Like it was, they were buying in Tampa when everybody else was buying in Tampa.
Yes.
They stopped buying in Tampa exactly when everybody else stopped buying in Tampa. Prices went down on the stuff they were holding. Um, so I watched the most sophisticated, data-driven folks in the world, and they just bought where everybody else bought. Um,
Yeah.
so I'm interested in the contrarian view that like what's in the models, or maybe it's vibes, maybe they didn't have a good vibes model.
I don't think they had good vibes models. I mean, I am a trained data scientist. I also think sometimes you just write about algorithm, or it's like similar to buying a stock, right? People pile on, right? They look at all of these things. And the thing about real estate that is tough to get right with the data is some of the supply data lags a little bit, right? And so, right, you're seeing all these people, they're like, oh my God, everyone's moving to Tampa. We should build in Tampa. But like 10 other people, more, 200 other developers are also thinking we should go build in Tampa right now. And like, you get some permits data, but it's usually later stage and you've already committed to something. So I think that's part of it. I
I was
also,
working with a
yeah,
compass agent in Nashville who actually has built a database in Nashville of the stuff that's coming online so that he can have that conversation with people. Like it was
Brilliant.
is a really fascinating model that he's built for that, that reason entirely, right?
Yeah, 100%. I'll just give you my sort of hot take. I personally think the long-term trend, the trend right now is people are moving south, right? My long-term thesis is that that's going to reverse in some way. I think because of climate change and because of affordability. It's just a cyclical thing. People moved to the Southeast because it was affordable, right? Nashville, great example. Great market, cool place to live, right? Now it's getting super expensive for people to live there. We're seeing that in Florida. You see that in North Carolina. You're seeing it in Atlanta, right? Like Atlanta was like the hottest place to buy forever, right? Now it's expensive for the average person relative to incomes. The Midwest, in my opinion, has a lot of affordable housing. It has, depending on the state and the city, there are places where they're pro business and, jobs are moving there. And I think they're going to have lower overall costs there long term, because if you look at insurance prices in Florida and the Southeast, like they're going crazy. We kind of got spared this last year, but I believe in climate change, so I just think that's going to happen more and more. And the costs are going to be really expensive to own those homes. You see what's happening in Florida, right? People are being priced out of markets there. And I think that there's going to be a move to affordability. And if the Midwest remains one of the more affordable places, that we're going to see that revive again. And I just want to call out that people say, oh, the jobs aren't in the North, in the Midwest, or, they're in the South. Well, businesses follow affordability too. It's not just individuals. And so a lot of businesses moved to Florida, right? Because it was more affordable, or to Georgia or South Carolina, right? And that might stay. But I would bet that the Midwest will be competitive for corporate relocations, for job growth, because they will probably want to lure those businesses back if they lost them, or they'll just, you can pay people less if you're in an affordable market, right? And that's better for a business's bottom line. And so that's kind of my counterintuitive take. It's why I think you see things like Intel building massive plants in Columbus, Micron building a huge chip plant in Syracuse, New York. These are affordable places to build a business, and the jobs will follow. And I don't think that's happening in the next 3 years or 5 years, but that's kind of like my, if you want to get the things the algorithms aren't going to pick up in 10 years, that's kind of where I think things might head.
I love it. And in fact, in some ways, you actually are seeing that right now. So available inventory of homes in Chicago and New Jersey and Connecticut are almost 70% fewer homes available now than in 2019.
Yeah, that's crazy.
And that's because, it used to be more affordable to, sell in Chicago and buy in Florida, but that equation has changed. And so I'm staying in Chicago.
Yeah.
And as a result, in fact, I was talking to an investor friend in Chicago who had a property in Chicago. He's like, that property hasn't gone up in value in 18 years. And then suddenly in the last 2 years, I've made all my money back.
Wow.
And, because there's very
just
few.
Hold on. Yeah.
Yeah, just held on to that time. And so in that, maybe that shift is underway already. And, that affordability shift is underway already.
Yeah. I think Chicago's an interesting example. They have their own problems because they're bankrupt and property taxes are very high there. But, I think Chicago's a great example of a city. Really big, diversified economy, great infrastructure for business and for people, high quality of life. I know it gets sometimes a bad rap for crime in the national media, but if you actually look at people's ratings of quality of life, and Chicago ranks pretty high among those places. I personally like Chicago a lot, just to visit. It's a fun city. But I think that's a great example of a place that I think will do well. If we really want to get nerdy about it, you also have something that economists call surplus capacity in terms of infrastructure. These places shrunk, and now they have big enough highways, they have big enough airports, they have enough infrastructure to support larger populations, which is good if people are looking for migration. And the last thing I'll just say about affordability is I think the concept that a lot of investors or agents should think about is not just absolute affordability, but relative. You look at the state of Connecticut, right? Like you've probably been following this as well. Blowing up the last couple of years, some of the fastest home price appreciation. If you're from Kansas and you look at the price of homes in Connecticut, you're probably going to faint, right? But if you are from Boston or from New York City and you're looking for a more affordable place to live, Connecticut is relatively affordable. And if you only need to go to the office 2 or 3 days a week, you can make that work, right? And so I think like that's why my whole thesis is about affordability, not just in regions, but even within individual markets. People, things are getting expensive. Inflation's crazy. Like people are going to be looking for ways to save money on their housing. And if you're in Boston, that might look like Connecticut. If you're in Denver, that might be moving to Aurora. It's not necessarily people moving across the country, but I still think the thesis of affordability, even within a market, is something to consider.
Yeah, or if you're in Chicago, that might be Grand Rapids.
Exactly. Yeah.
Right.
Yeah.
Yeah, that's really in that intra. It doesn't have to be the whole north to south. It's like inside the state or inside the region. Chicago to Madison or Grand Rapids is an appeal for some people. That's really
totally.
great.
And we've seen a lot of that major migration start to reverse. Like I personally, as someone who grew up in the East Coast, I've lived in Denver, I lived in Europe, I now live in Washington. Like it's hard to move away from your family and friends. Like I think that's just like a lot of people during COVID were like, screw it, I'm going, and now people are moving back. Like, so if you can find affordability closer to home, I think those things become more appealing.
Okay, I'm going to plant a seed with you, Dave, about affordability. There is excellent data that shows how high property taxes creates affordability for the entry level. Okay. High property taxes keep home prices lower. It makes holding costs higher. Therefore, you get more homes back on the market. You get greater inventory per capita. You get a cheaper entry cost. Low property taxes in a place like California, locked in low forever, means you hoard real estate. It keeps fewer homes on the market. It drives the entry cost up. So in your model, and maybe it's just your vibes model, my suggestion is look for the high property tax areas as the opportunity to fulfill your affordability scenario. So for example,
super interesting. Yeah.
Yeah. So for example, New Jersey is a higher property tax area.
Yeah.
You come out of New York. Yeah. You come out of New York and you get relative affordability in New Jersey. California is a low property tax area. You come out of San Francisco, you don't get affordability nearby. It's still expensive. So you can't move to suburbia and save money. And one of the reasons is that the high property taxes in New Jersey keep the home price lower, better affordability for the longer term. It shifts the cost to the future when you have more money.
Interesting. Oh, I've never thought about that. That's an interesting, So do you have any other examples other than New Jersey of places that are high property tax that allow, I guess Chicago, right? They have a pretty high property tax. They're relatively affordable.
Compare Texas to California.
Yeah, right.
Texas is a high property tax state. And one of the reasons that affordability has remained great in Texas is because high property taxes means the holding cost is higher. You don't hoard real estate as much. Per capita inventory is much greater, like maybe 8 or 10 times greater than it is in California. And so you get an affordability improvement because of that. People in Texas hate it when a guy in California says, "I praise you for your high taxes," but I think it's true, and I think it's a real insight. And I also you can see states right now, Texas and Florida in particular, which are campaigning about like, can we drop the property taxes? And I believe that's killing the affordability golden goose. And it'll be really
Interesting.
fascinating to see how that trains over time.
Yeah, that trend is, I think I saw 15, 18 states right now have
So
something. I don't know how serious they are.
in your
Like some of
vibe
them,
model.
yeah, interesting though. Thanks for sharing that. I'm going to look into that.
It's great. Um, okay, let's talk a little bit. We've already blown through an hour. It's amazing, really great conversation. Appreciate it very
Yeah.
much, Dave. Let's talk though about your vision for the future. What should we know about the next decade? You've been talking about demographics and you've been talking about climate change, and well, tell me about your thesis for the next decade of real estate investing. For example, does it change as the demographics change? Like there are some models which show us, hitting population peak in the U.S. We're cut off immigration and we're not having babies as much. What do you think for the next decade or 20 years? Because it's a buy low, sell never kind of model. Tell me about the
Yeah.
future.
It's a great question. I think there's a lot of open-ended questions. I would say for the next 5 years, to the end of the decade, let's call it to the 2030. To me, I feel like we're what I'm calling this great stall. I think home prices are going to stagnate, even though affordability is going to lower transaction volume. It's going to lower demand. There still are the demographic tailwinds that, there's a lot of pent up demand, in my opinion, from millennials, right, who want to buy homes. And frankly, in a lot of places, it's still cheaper if you got a 2 or 3% mortgage. It's cheaper than renting. So like even if the economy turns, I don't personally. I'm curious your opinion, Mike. Think we're going to see like a massive supply glut come on the market unless things get really bad, right? If you see unemployment hit 10%, who knows? Who knows? All bets are off at that point. But I do think what's going to happen in the 2030s is, yeah, we're going to face a demographic challenge in real estate and as a country, if unless immigration pendulum swings back in the other direction. Like we don't know. There are two things that are going to, lower household formation going forward, like our lower birth rate, which personally I don't really see changing. Immigration, is a function of policy, and so yes, we're sort of at one end of the spectrum right now with immigration. Could that change in the future? Sure. But for, right now, I'm going to assume we stay in a low immigration environment. I think Harvard just released a study about this, but it's going to definitely lower cumulative housing demand. We're also going to be in, I hate the term the silver tsunami, but I don't think that's like a cliff that's going to happen. But I think we will get continued increases in supply dynamics, probably from aging boomers. And that's going to create, we could go from the structural supply shortage that we're in now to at least an even market, or perhaps even an oversupply. I don't think that's happening in the next 5 to 6 years, but I think, if the trends stay that way, we'll see that. And because of that, Mike, I get nervous about that. I've started looking at what's happened in Japan or in Germany or in other countries that have had declining populations. And what you see is sort of an acceleration of the trends that we see in the US right now, where actually cities and places with high economic concentrations, the real estate's fine. It's fine. It's the rural areas that really start to hollow out. And that's scary for rural areas, but that's just what I've seen in other markets. And my best guess, because there's a lot of variables here, is that if the trends stay the way they will, we're going to see weakness in housing supply, and we're going to see weakness in housing prices in rural areas. I think even in a lot of suburban areas, and the cities that drive so much economic value are going to continue to be just fine. And that's my best guess for the next 10 years. I'm
That's
curious
I
if you
like
have any
that.
thoughts on
I
it,
think that
though.
is a
Yeah.
well. I think it's a well thought out thesis. The fact that like it's the that it is a has a economic center as the place that survives, I think is a I think you probably construct the argument the other way too. In a remote work world, maybe the exurb is what survives. But I like that you've pulled it together that way. That's a great insight. And it's really probably the 2030s
Yes.
When we see that change really shift, it's probably we got the next 5 years are still on this current path. There's still a lot of millennials who don't yet own homes, and I think so. There's that motion. There is I think a lot of transfer from the boomer to the next generation. So I don't even see that as a lot of supply. I think it's like, oh, how am I going to, how, as a Gen Z, how do I get a home? Well, I inherited from my grandparents,
Hopefully, yeah,
like
yeah.
I think there's a lot of that still happening.
I actually did a whole podcast episode
So,
about this
well, that's
topic the
terrific.
other day,
I like
Mike.
the insight.
Yeah, the other thing I'll
What did
say
you?
is like the big variable that we don't know is like how the construction industry will respond, right? Because like right now they're building because we're in a structural deficit. If we're if demographics change, are they going to slow down building? Like maybe if they do, then this doesn't become a surplus of supply, right? And I think what a lot of people overlook is the fact that about 400,000 homes a year become obsolete, right? Just because vacancy or they're just too bad that you can't do that. So that takes supply off the board. So there's so many
Age
variables.
out. Yeah,
It's super hard to predict all of these things, but yeah, I think it's safe to say that we're going to switch from a demographic tailwind to a demographic headwind is like definitely going to happen. How all of these things respond is hard to say, but I don't think it's like an emergency right now, but it's something to keep an eye on.
for sure. For sure. Dave Meyer, this has been a terrific hour. I appreciate it very much. It was a great lesson in investors, and I love the thinking about agents working with investors, investors working with agents. Lots of great lessons on investing per se. You run at least one podcast, but maybe two at BiggerPockets. Tell me about where do people listen to more Dave Meyer?
Absolutely. So I host two podcasts. One is the BiggerPockets podcast. If you're interested in learning tactics, strategies about being an investor, check that out. The other one is called On the Market. It's more of a data and economics show. We have a lot of industry folks who like listening to that show. In addition, we have Mike on as a frequent guest to talk about inventory, but we talk about everything from how the labor market impacts real estate to AI and all these trends that just impact the industry. So you can hear more from me on both of those shows.
Terrific. All right, everybody. That is the show for today. Thanks for joining me for Real Estate Conversations. My guest is Dave Meyer. If you enjoyed the show, I always appreciate a like and a 5 stars and a recommendation so that other people can find the show. It's been great, Dave, talking with you, and we'll do more soon.
Thanks so much for having me, Mike.
The Real Estate Conversations podcast is brought to you by Academy, the go-to source for real estate agent education and on-demand learning. All agents have access to Academy's extensive library of content, video, and technology for building a high-performance real estate business. Academy is also one of the reasons that our agents are the most productive in the industry. Learn more at the Academy link in the episode guide.